You're listening to the Infinite Banking Mastery Podcast. Did you know that you could build a tax-free pool of wealth that's liquid and accessible all your life while building your retirement nest egg? Gain full control of your financial future and stop relying on the government and banks. The wealthy have already discovered this wealth-building secret. Now it's your turn to get financially secure without following the conventional wisdom that keeps you in debt to banks. Now here's your host, Valerie LaRocque.
Hello, everyone, and welcome to another episode of the podcast. Thank you so much for being here and for listening in. Today, I wanted to talk about not just whole life policy structure, but specifically the 90-10 policy structure. Some of you may not have heard of this. A lot of you may have heard of this. There are a lot of people out there talking about this and saying it's the right way to go. This is how you should build your policy. And frankly, it's dangerous, to be quite honest. Building a policy 90-10, which really just means 90% of your premium is going into the paid-up additions rider, and only 10% is going to the base premium. Even an 80-20 split is dangerous at times too. And so your advisor really needs to be careful and know what they're doing. And then you both need to be keeping an eye on that policy. But I wanted to get into this topic. And so to start off, just to refresh our memories, I wanted to talk about MEC again, which stands for Modified Endowment Contract. So of course, first of all, it's not the end of the world if you end up MECing your contract. All it means is that it will be taxable just like everything else. All your investments currently are taxable, either now or it's deferred until your retirement years, but it is all taxable, aside from a Roth IRA. So it's not the end of the world. The worst thing that can happen, you'll be taxed on your gains. However, we would like to avoid that taxation as much as possible or as long as possible, and that is one of the awesome things about the whole life. Now, if our policy does become taxable because we have MEC'd the contract, that will be taxable as ordinary income, which is the highest way you can be taxed. So once that contract MECs, again, it is no longer seen as life insurance, but instead more like an investment. So if we've MEC'd our contract, or what a MEC contract looks like then, is something that will be treated similar to a retirement plan, like a 401k or an IRA, meaning that the earnings inside is tax deferred. And also, if you want to access those earnings, you will be penalized at 10%. So even if you want to just borrow against your policy, you will also be penalized the 10% for any of the portion that is earnings on the contract. So it's definitely not as favorable. And if a life policy becomes a MEC contract and then it endows, that just means that the policyholder paid more in premiums than the IRS allows for that contract, and also that the contract has reached its maturity date or its cash value limit. Now, normal maturity date for a life insurance contract is around 121. It depends on the company. Used to be age 100, 120 with some companies. So usually it's much, much older. But if there's too much cash and you reach your cash limit prior to that, it can endow. And if still alive, you would have to pay income tax at ordinary tax rates on all of the earnings on your contract at that time that it endows. And so certainly you're likely to be an old person. It's not going to be joyful to have to suddenly pay a ton of tax on a contract that which you may already have spent the majority of that money. So we don't want our contract to MEC, although keep in mind, even if it does MEC, the death benefit is still tax-free to your beneficiaries. But keeping it tax-free is one of our major goals. It will still grow well. It will grow very well. We just want to keep it tax-free because if we reflect on our history again, our taxes were over 50% for 54 years of our tax history, which is about half because we've had income taxes for about 110 years. So for 54 of those years, our tax rates were over 50%. So when you reach retirement, your retirement years, could they be 50% or higher again? Well, yes, they could be, because Uncle Sam certainly needs more money, I would say, with the way that our country spends and all of the needs of our country and Social Security and Medicare and Medicaid. And so remember that Uncle Sam is a business partner on all of your retirement accounts, all your deferred money, and also your MEC contracts. And that business partner can raise his partnership percentage of your money whenever he needs more money. So it's rough, kind of hard to just trust that those tax rates will be fine when we reach retirement, when we don't know what they're going to be. So there's that tax rate risk. They could be higher. They've been higher, very high, for half of our income taxation history. So we want to look out for that and try to keep our whole life policy income tax free to protect from that, certainly because of all of your other retirement accounts are taxable. So I've been talking about endowment and your policy possibly becoming a MEC at maturity or right before maturity, but your policy can become a MEC at any time. And so it doesn't have to be at maturity or when you're much older. So though it's not the end of the world, it's certainly not great and something that your advisor should be avoiding at all costs. Now, before I go into part 2 of this discussion, I want to mention how sometimes a MEC contract is exactly what someone is looking for. Sometimes it's perfectly fitting for their situation. Usually when this is the case, I am building a policy for a client who only wants to fund the policy for 1 year. And then it definitely is a MEC because you have to fund the policy for a minimum of 7 years. Of course, even though saying 7 years is generally the number, you still would want to check the contract if you want to stop payment after year 7. So if a person wants to fund for 1 year, the policy is an automatic MEC, and then in year 2, we would reduce pay up the contract. We use the verbiage RPU, the acronym. So we would RPU the contract, which would mean that there would be no more premium after year 2. And so sometimes people just want to move cash from a CD, from a money market account, from some other account where the money is sitting, and they just want to protect it. They want it to do more for them. They want to have that bump up in death benefits. So if something happened to them, their cash actually would leave a higher death benefit to their loved ones. And their cash would also be growing quite well for them inside of a whole life contract. It will be a little bit behind, say, a CD or something in the first few years, but then it will start rocking and rolling and doing great with the growth. It's just, of course, going to be taxable. So it has to be for the right person, for the right scenario, and the best alternative amongst the other alternatives for that client. So now back to the 90-10 structure, or maybe the 80-20. I don't think it's a great idea. I don't usually build contracts like that unless it's perfectly the right situation, the right idea for a particular situation. It's just more risky. And so here's the reasons why I do not like it. First of all, we have to keep in mind that the base premium is basically like the fuel for your contract, because the paid-up additions will eventually have to be dropped off. Depending on how it's structured, it may have to be dropped off in, say, 4 years. Maybe you'll have 10 years, or maybe you'll be able to fund it for up to 20 years. So it's going to have to be dropped off, though, at some point in the future. And so you want to have a decent sized base premium, because that is going to be the dollars, the premium that's going to be funding and fueling your contract's growth. If you minimize that a lot, it's not going to be able to grow quite as much. You're just going to have less money in there because you're putting less money in. You're not going to have much fuel. And so, yes, when you overfund a contract with a whole lot of paid-up additions, the cash value will grow more efficiently, but that doesn't mean you'll have more cash in the policy because you've put less in, again, like I just said, and you're going to have to drop that paid-up additions. People who do structure their contracts in this way should really be prepared to start policy after policy after policy as soon as you have to drop off that paid-up additions, because you have so much of your premium being lopped off that you should be able to continue with that 90% in paid-up additions that you just removed from your premium. You should be able to start another policy with that 90%. And so you're going to want to be able to continue to build your system. Your policy is going to have less cash because you're funding it with only 10% in premium now, with policy number 1. So you're going to want to start another policy, a second pool of cash, to be able to continue to grow your banking system with whole life policies. But even doing that, even planning to start policy after policy once paid up additions have to be dropped off of contracts 1, contract 2, et cetera, it's going to cause you to lose time because you're going to have to wait until you have that money available from dropping it off of contract number 1 to fund contract number 2. So you're going to have loss of time a little bit on that as well. But to best grow your system in this way, you would want to lock in your health and insurability because you're going to need to open more than one contract for sure if you're funding with such a slim base premium. So you're going to want to be able to lock in some term insurance so that when it's time, when your paid up additions is required to drop off so you don't MEC your contract, you're able to easily and quickly open your second contract with no health or no financial underwriting so that you can continue to build your banking system. However, another downside to building your policy in this way is that in order to have such high paid up additions going into your policy, you usually have to have a pretty significant term rider inside of that whole life policy to be able to put that much money in. Because remember, you have to have a certain amount of death benefit. If you put too much money into a contract as compared to the death benefit, it will become taxable. So you have to boost that death benefit up in order to fit more dollars in. And so you have to do that with the term policy, a term rider inside of your whole life policy, which is different than what I was just talking about, a separate term policy that you can convert later when you want to start a second whole life policy as part of your banking system. So if you want to have really high paid up additions, you're going to have a term rider inside of your whole life contract. And it's usually pretty high in order to be able to fund so much paid up additions. So what that will do is it will limit your overall insurability. Because if you have to add $2 million of term insurance inside of your whole life policy, that's going to boost up your overall death benefit so that later on, or even you wouldn't maybe be able to be approved for a second term policy in order to be able to convert in the future when your paid up additions drops off. You may not be able to qualify for that in the first place if your whole life policy with the term rider is too high of insurance, because there is a maximum insurance that we talked about before that would not allow you to acquire maybe enough death benefit. So choosing to have a really skinny base premium and a high term rider inside of your contract so that you can fund a 90% of your premium in paid up additions may end up being that you can not be insured for very much more as a second policy. It's standalone term policy that you could convert later when it becomes, I guess you could say, necessary to convert because you have to drop that paid up additions off of your whole life contract. And now you want to grow your system. You want to keep growing your pool of cash. You're going to have to get another life policy. But if you're maxed out on insurability because of the term rider within your whole life policy, you may not be able to do that. And so you'll have your policy and then you'll think, that's okay, I'll just re-underwrite again. When I have to drop this paid up additions off, I will go through underwriting again to get my second policy. However, you never know. Life happens. Something could happen. Something unexpected could happen to you. You may become uninsurable for some sort of reason, some sort of sickness, or who knows, and you might be stuck only being able to fund that 10% base because you have a 10% base with your 90% goes away and you weren't able to acquire a very large term policy on the side because you were maxed out with your insurability, your insurance, the max insurance that the company will give you. And so that's not going to allow you to grow a very big banking system within your whole life policy contracts. Another thing is, even if you decide, that's okay, that's what I want, I'm going to insist on it, your advisor's for it, or you've contacted one of these people who is all about it. The thing is, the illustration software is also not perfect. How unfortunate. So even if you have an advisor who's really looking out, who builds an illustration, it says it's a non-MEC, of course, I'm sure they're planning it's going to be a non-MEC from the beginning. Being that close to the MEC line would definitely allow your policy to MEC easily. Much more easily, even though it may have been constructed with a non-MEC and your advisor may think it would be fine. Even dividends that you earn in the policy could cause it to MEC if you're that close to the MEC line. Or another thing that can easily happen is you may have planned out year one that you want to pay an annual premium into your contract, or you expect to always want to pay an annual premium. And so that's how your contract is designed with that intention. And then something happens in the future, you don't want to fund annually anymore. It just works out better for you to switch to a monthly mode. Even that action could cause your policy to become a MEC. And so you want an advisor who really knows what they're doing. It's just a very touchy thing. So you want that person to know what they're doing and how to really put some buffer in there, put a little bit of space so that your contract is not so easily going to MEC. One thing I wanted to point out as well is that some contracts allow you to put in more money than you started with. Let's just say you start with an annual premium of $10,000, but you actually can fund $12,000 into the contract, or a little bit higher, because they have a window of how much you can, like a range of how much you can add into the contract. So even though that's allowable in the contract, and sometimes clients will call on their own and say, hey, I want to fund my paid up additions. Oh, hey, I can put $2,000 more. How cool. I think I will. People do this all the time. And you got to be careful, because now you're getting closer to that MEC line again. And so even though that may be allowable, you always want to make sure that it's going to be okay. And so numbers can be run with the company that are current to check to see, can I add that extra $2,000? How long can I add that extra $200? Will I be able to continue doing that for another 2 years, 3 years? What happens if I skip this year? So it is possible to test with the company what's going to happen if you add more funds into it, even if the contract allows. You just want to be cautious and not think, oh, my contract allows it, I'm going to go ahead and add that extra money in. Just because it's allowable does not mean it's advisable. Now, one thing that is good is that the company does say, well, if your contract is about to become a MEC, or you just sent in premium that would cause it to become a modified endowment contract, we will notify you. We will notify you so you have the opportunity to reverse that action, or pay less in paid up additions, or do something to keep it from becoming a MEC contract. Now, this is great, but if they send you a letter warning you of this potential MEC, or that your contract has MEC'd, and they give you a time frame to respond to it, and you don't respond in time, that MEC will become irreversible. Now, I just want to ask you a question for those of you that do currently have life insurance contracts, or even a health insurance or car insurance. When you see mail roll in from that company that has your life insurance or your car insurance, your health insurance, do you just run to that letter and excitedly open it up and think, man, what do they have to say to me? I better open this letter pronto. This is an exciting piece of mail. Unlikely. You probably see the mail, or maybe you don't see it. It sits on the table for a while, or you ignore it completely because it's very disinteresting. So you might not even see the mail within the time period that the company gives you. And so that's a risk. Also, your agent or advisor should receive a letter of that as well. Usually the company's not sending emails on this information, they're sending mail. So again, something that could be overlooked by your advisor who's getting tons of mail, or maybe you never know when this actually happens. If you were to have a MEC contract, maybe your advisor's out of the business. Maybe your advisor's either retired or just out of the business. This actually is a really high turnover industry because it's a very difficult industry to work in. And so the failure rate is very high. For me and my team, we do our best to be on top of everything, be very diligent. And I would expect any company that bought out my book of business or took over my book of business at the time that I eventually retire would be on top of everything as well. But you just never know. You never know what could happen. And you don't want that risk of your policy becoming a MEC. And then the company tried to warn you, but you didn't see the letter because you saw that mail and it was so boring you didn't want to open it. And now you have a MEC contract that's irreversible. I simply prefer not to have my clients at such high risk of their contract becoming a MEC. So when I'm building those contracts for them, I am paying as close of attention as I can to leave some buffer room there to get them as close to the MEC line as I can, so that the contract is very efficient, to be able to also keep in mind their ability to fund the premium, what's going to work for them, how they're going to be able to fund it. And also keep in mind, I want to add in a little bit of a buffer so that some dividends isn't going to push us over into a MEC contract. And so for those of you who are looking for a solid contract, a solid advisor to help you, who's going to be looking out for your best interests, who's going to build you a great contract according to your needs, your goals, and your budget, feel free to reach out to me. I would love to connect with you and help you through this. All this might sound really complicated, but really it's not that complicated. I just wanted to share how, it is a really sensitive thing. You don't want to build your contract so close to the MEC line like so many out there are announcing and trying to get everybody to think that that's the best style of contract, because it is a touchy thing and you don't want to accidentally cross that line. So instead, let's build the contract more safely with a little buffer, and really the way that Nelson Nash advises that we build the contract. He has a specific way that he advised us to build it. We do move things around from there according to the client's needs or their budget, and we can kind of move things around, but we are kind of starting from a baseline of keeping the contract safe and a little bit away from the MEC line so that you're not so easily going to cross it. We want that buffer. So you can reach me at Valerie@alphaomegawealth.com if you would like to touch base and find out how this could work for you. I hope that you enjoyed the podcast, that this was helpful information, that it helped you to see why the 90-10 is not awesome. And I look forward to talking with you or talking at you again next week. Thanks again for listening in. I hope you have a great week. Take care.
This is the podcastfactory.com.